Seven lessons that will teach you a year's worth of trading wisdom. I'm Manil, also known as Ghost of Trades, and I also run Unbiased Trading. Now, I'm currently away from my main kind of like desk setup, so currently I'm recording on a laptop, so my apologies for the microphone quality and also for this being completely unedited and just kind of off the cuff and just my kind of views, whatever comes to my head around these kind of lessons. Now, I did actually a tweet on this topic and it was decently popular, and I kind of just wanted to expand upon it with my own thoughts, lessons that I wish I had kind of learned early on in my trading. And the whole idea of this is really to try to extract the key lessons I would have wanted to know in the first year of trading to give you kind of a year's worth of trading wisdom. Let's go straight into it. So first is varying perception. Now this one, there's a couple ways to look at it. So one is looking at it in a varying perception way that you should be a contrarian. So instead of, if everyone's looking at the market in a certain way, you should try and look at it the other way. Or so the other way of things that if everyone thinks it's a bullish market, then maybe, look for signs potentially of it reversing potentially. Now, you can be dangerous on both sides. If you're a contrarian all the time, especially in small caps and things like that, you're going to get burnt a couple times. So you need to be incredibly good with your risk management. But personally, the way I like about thinking about varying perceptions is being very open-minded on how people trade and seeing how things could incorporate into your own trading, and not necessarily just having this one mindset that this is the only correct way of doing things and there's no benefits of us other sides. In my opinion, everything is pretty much an opportunity cost. So, some discretionary traders, in my opinion, are insanely good at what they do, but there is a downside of that. They don't have a repeatable system as much, so it's very hard for them to get, really high conviction when they're performing kind of badly recently. And then, sometimes data can come in to help with that, but there's different ways around it. And then if you look at, a full systematic trader, there's definitely downsides to that because he can't read nuances in the market like a discretionary trader could. So there's the pros and cons on every side of any way you go about trading. But just having this varying perception and idea of being aware of that, I think is really important. Next is simplify your trading. Now, I wish this lesson really stuck with me in my first year. First year, I was trying way too much, trying to use everything I was learning and things like that. And I think it's only natural when you're, getting into trading. There's so much information out there that, you're probably going to stumble upon some things that you probably don't actually use later on. And it's just going to be through iterating to find out what those are. But if you are aware of that and you routinely, I would say, check your trading and say, am I using this? Am I finding this beneficial? Do I have any data to show me that this is beneficial? Things like that can really help you kind of clean out that clutter. Because, I still remember my trading view screen from back in the day. I had at least probably like 10 indicators of different things that I had no idea what they even really meant or, what they were actually doing. So that particular part is very important. And then there's also simplifying your trading in the way of like, if you want to avoid overfitting your data, well, overfitting your strategy, sorry, to historical data, then simplifying your strategy into, the least amount of parameters possible, or just the ones that actually hold weight, is also super beneficial to your trading. So there's always kind of multiple lessons in these. Next is explore different styles when you are starting out. Originally, I went in and I was just kind of stuck with large caps because that's kind of what I was exposed to. And then I slowly moved over to small caps. But I think after that, I didn't really try anything else. Now, there's definitely the benefit of focusing on one strategy or one market and getting a lot better on it. I definitely think that is a huge pro and it's definitely needed for traders at different points. But I would say your first year, give like 2 months to like every style of trading. Try futures, try small caps, try large caps, try maybe, well, I guess in the first year it'd be a bit difficult to be fully systematic on anything, but try different styles, try scalping, try swing trading, those kind of things, and see what maybe you see either the quickest success in, or what you think actually really fits your personality. So for me, small cap shorting really fit my personality. I was always liking to think in a contrarian way, and I always thought that small caps fundamentally are like trash companies for the most part. So it logically made sense to me why I could short these. For some people, logic doesn't need to be as important. Some people are viewing it, simply as like a scalping kind of thing, and there doesn't need to be as much logic to that trade. However, for me, I was very logical in my thinking, so that was really important to me. Otherwise, I probably wouldn't be able to hold a trade at all. So things like this is, especially in your first year, take advantage that probably in your second, third, and fourth year of trading, you're not going to have time to, try different styles because you've already accumulated so much time on one particular style. It's going to be quite hard to navigate and change over to a new one. And if you do, you're sacrificing what you were kind of good at. So definitely take advantage in your first year of trying out different styles. Next is uncorrelated return streams. Now, this is based off the Holy Grail by Ray Dalio. Basically, he just says, have different uncorrelated assets or return streams, and this can also be used in uncorrelated strategies, which has also got popularized by like Jim Simons and things like that, and that's what he used in his hedge fund. Um, so this one's key for knowing that this is kind of the end goal ideally for some traders. At least for me, I want to build a portfolio of uncorrelated kind of algos and let those run, and then just be the person behind testing new ideas because edges do decay and you need to find new ones at points, and also keeping your kind of I guess finger on the pulse of the market is also really useful because going in from cold is quite difficult most of the time, at least from what I found. So focus on this as like an end goal if that is the way you want to go about it, or even just take this as an idea that you want to have some sort of end goal that you're building towards. And at least some of the best traders out there have said uncorrelated return streams or strategies is one of the best ways of doing the most amount of profit, but for the least amount of risk taken on. And I've personally experienced that myself. Having uncorrelated strategies matched to each other, or even just having a mean reversion and a trend following, the amount of less drawdown you get is just incredible. And yes, your profits may not be huge, or increased an incredible amount, but I mainly care about the downside risk, and I think this will lead into a lesson kind of for everyone from this. You don't need a high win rate to be profitable. Now, this one is mainly on the point that like there's nothing in trading where it's just you need this except maybe risk management. And even that one, I personally would debate that there are different risk management styles, and I think you do need at least one. But there are definitely different ways, and for different strategies, you can get away with things that are not very common. I know people that don't actually use typical stop losses in the way, and that's because their algos are more swing trading algos, and it actually doesn't make sense for them to use stop losses in the common way. So I think every rule in trading can be manipulated to some essence, and this is really just going on the point that like if someone is advertising to you, you need like a 90% win rate strategy. That's probably actually not the case all the time, and you could do really good with a strategy that's like a 30% win rate, but has a really high R return on some trades. Now there is a caveat, and personally one I do prefer. Funnily enough, I do prefer higher win rate strategies. Reason being is they're just a lot less volatile, a lot less drawdowns, and you aren't as dependent on one or two trades that if you do miss them or for whatever reason you cannot trade them, you will miss out on an insane amount of gains that would recoup a lot of your losses before. So I do prefer high win rate strategies, but there are killer traders that do low win rate as well. So just take this as the idea that trading everything to some extent is like an equilibrium, and you don't need to be on the extreme of either side for most things, and things can be changed for whatever trading style you're kind of actually doing. And lastly, I think is trading is a probability game. So there was a really good video that I put with this tweet on my Twitter, that it was a guy saying that most people think of possibilities in trading. They think, oh look, if I take this trade, it maybe could go to 10x or whatever from the current position. Whereas realistically, you should be thinking probability wise. You should be thinking on historical data or whatever data you're actually using, maybe even if that's manual tracking data or just your own sample size that you have in your kind of head because you've been trading for 5 years. Everything in some essence is a probability. I do obviously sway more on the side of actually just using cold hard kind of like data, so historical data, doing testing, things like that, to get you pure probabilities. But just thinking in a way that like just because something has a possibility of happening doesn't actually mean that's a good trade. You want to be thinking, hey, is this like high odds of this happening, or even if it's low odds of happening, but it over a large enough sample size, it would still be profitable. Then that's still like a viable way of doing it. But just don't be reliant on hopes of one particular outcome happening just because it could be a possibility in a trade, because trading is completely random distribution when you're actually working on things. So pretty much anything can happen. Anyway, thank you for watching. That was kind of like everything I have on these kind of particular thoughts. Let me know if there's anything else you want me to expand upon. I'll probably reply to some of the comments on this video just because I know I could have put more time into this video. However, I'm just away from my current computer, so my apologies for that once again. But I'll be back probably next week with a proper fleshed out video. I'll keep on putting out as many tweets as possible on just things I'm thinking about and whatever I'm learning. So be sure to follow me on Twitter as well. But thanks.